Hello. It is now my great honour to introduce you to our last keynote speaker of this second day, Governor Andrew Bailey of the Bank of England. He was appointed Governor of the Bank of England in March of 2020. He was previously CEO of the Financial Conduct Authority from 2013. Prior to this, Governor Bailey was Deputy Governor of the Bank of England from 2013 to 2016, and in parallel, in 2013, he became Chief Executive of the new Prudential Regulatory Authority, the PRA, when the bank took over responsibility for prudential supervision for credit institutions and large investment firms. He has been at the heart of the financial system during key structural shifts in the UK economy and the financial system. During his career, he's also held senior roles at the Bank of England and the Financial Services Authority, ranging from economic analysis to resolution to prudential supervision and banking services. It is well known that the Bank of England is one of the pillars of the NGFS and is actively mobilising in preparation to the COP26. Earlier this week, Governor Bailey said that our exposure to the planet is the ultimate systemic risk, as the economy and financial system, along with society, are exposed to planetary level changes. We look forward to hearing where and with what extent the Bank of England is considering its response. With a special speech, Tackling Climate Change for Real, Progress and Next Steps, I hand over to Governor Andrew Bailey.
Oh, thank you for such a kind introduction. And it's a real pleasure to be participating today. I really would, of course, much prefer to say it's a real pleasure to be here today, but unfortunately, I can't yet be in Basel, but we're looking forward to the next time we can, because this really is a unique event, and I congratulate the organisers for putting it together. Over the recent decades, our global economic system has faced multiple shocks or SWAN events. We've had a COVID-19 pandemic and we've had a global financial crisis. But if we look forwards to the future, there is, of course, another SWAN out there in the reeds, if you like, and it's a green one. And that's why we're here today and why this conference is so important. And that's the threat posed to our economies and our financial system by climate change. In the aftermath of the financial crisis, central banks, regulators, policymakers came together to reform the system so they could better face up to and weather future shocks. And we've got to do that again. We've got to come together, as we are today in this event, to address the threat of climate change. But of course, the big difference is that unlike the financial crisis, when we did it after the event, we can't wait for that. We've got to do it before, and we've got to do it quickly. Now, on Tuesday, I spoke about the role that central banks have to play on climate change, and that it isn't, if I take the case of the Bank of England, it isn't a new objective. It sits firmly within the bounds of our mission to maintain monetary and financial stability. And we have an important role to play. But notwithstanding that importance, it's governments, businesses, investors, and individuals that have the most difficult and most impactful decisions to make in driving the transition to a net zero economy. So what I want to do today is build on the remarks I made earlier this week to reflect on central banks' climate-related work to date and to consider how it will need to evolve if we're going to continue to meet our remit. And I want to talk about really three main areas of our work. Firstly, improving the understanding of climate-related financial risks across the financial system and the economy. Secondly, developing and embedding climate risk management in the financial firms that we regulate. And finally, seeking to achieve best practice for our operations as a central bank. So let me begin with understanding the risks across the broader financial system and the economy. The NGFS really is a pioneering body, and it's continued its work in this space through publication of climate scenarios that provide a common starting point for analysing the risks to the system. And we're lucky that the latest, the newest version of those scenarios is going to be published soon. And what those scenarios do is bring together the financial and economic impacts of different temperature and climate policy pathways. And they're a critical input to firms and policymakers to understand the future impact of the decisions that they're making today. So with scenario analysis, we can make questions like how resilient is this business, this financial system, this set of policies to each climate scenario possible to tackle and address and come up with answers to. So we are at the Bank of England a strong advocate and participant in the NGFS's work. And a couple of years ago, we announced our intention to assess the resilience of individual banks, insurers, and the wider UK financial system to different climate scenarios through what we call a climate biennial exploratory scenario. Fortunately, we don't say that often. We say CBES, which is the anagram. I'm pleased to say that that exercise, which draws on the scenarios of the NGFS, is going to launch next week on the 8th of June. It will involve the UK's largest banks and insurers and explore 3 different climate scenarios, testing different combinations of physical and transition risks over a 30-year period. And this is going to be a very important tool to size the financial exposures, to understand how different bank and insurance business models will be affected and how they can respond. And finally, as a way of improving risk management in firms through the process of carrying out the exercise itself. So firms should use the CBES and the underlying scenarios of the NGFS to inform their own scenario analysis, build their understanding of climate risks, and enhance their climate risk management capabilities. And I hope, and I'm optimistic, that it will act as a catalyst. And that catalyst will be to increase firms' knowledge of the risks they face, and by the way, our knowledge of the risks the system faces, and incentivize steps to be taken to address those risks. And this will require the clients of firms in the real economy to improve their understanding of how climate change and the transition to a net zero economy could impact their businesses and operations. We will share the lessons that we learn from the CBES with the network, with the NGFS, because that's inherent in the collaborative approach taken by central banks. And on that note, let me commend the ACPR's recent publication of its own ambitious scenario exercise of the French financial system. I mean, it is absolutely wonderful and great to have fellow central banks, doing similar things so that we can learn from each other, compare our exercises, because we're going to obviously be doing them again. So through both its scenario work in the NGFS and internal analysis, the Bank of England has developed a clearer understanding of where climate knowledge gaps persist and what these can mean for our objectives. Take an example. There's particular value in the deepening of our understanding of the macroeconomic implications of climate change and the pathways to net zero. It's for governments to set out a pathway to net zero and the policy levers that will be used to deliver it. But as central banks, we will need to understand any implications of the transition for the economic outlook and for our potential policy responses. Now, the NGFS has started to explore this, but more work will be needed as the impacts of climate change and the transition to net zero start to come into sharper relief. So at the Bank of England, the Monetary Policy Committee recently, last week in fact, had its first informal discussion of the macroeconomics of climate change. And climate is an increasingly important part of the G7 discussions between central banks and finance ministries, the latest round of which are going on this week. But more work and discussion is needed. And I would point specifically to 4 points. First, further integrating climate and macro modeling. There's a lot of work to be done there. Second, understanding and sizing the related transmission channels. Thirdly, going beyond aggregate impacts to understand sectoral implications. And fourth, assessing how the transition might affect both the demand and the supply sides of the economy. Because what is, I think, increasingly clear is that the effects of climate change and the transition to a net zero economy will manifest themselves over time. So that analysis needs to span the short, the medium, and the long term to capture these full effects. I want now to turn to how we're embedding climate risk management in the financial firms that we regulate. We've worked to deepen our understanding of risks to the financial system and build resilience to climate change both at the macro and the micro-prudential level. At the microprudential level, the good progress regulators have made through climate-focused fora, such as the NGFS and the Sustainable Insurance Forum, has catalysed work across international standard-setting bodies and other authorities, including the Basel Committee and the Financial Stability Board. And I welcome very much that the FSB is taking the more strategic and central role on climate-related financial risks across the wider financial system. And I can assure you that that's something we discuss regularly at the FSB and has very high importance. In the UK, the Prudential Regulation Authority, as part of the bank, set out supervisory expectations for banks and insurers on the management of the financial risks from climate change almost exactly 2 years ago. We've provided further guidance for firms on these expectations and have set a deadline for firms ambitiously to embed them by the end of this year. Now, of all the building blocks required to manage effectively climate-related risks, disclosure is amongst the most essential. It's not only for transparency and for risk management purposes, but also to facilitate the flow of capital towards investments that are consistent with an orderly economy-wide transition to net zero. As a consequence, it's integral to the UK's legislative commitment to reach net zero emissions by 2050. For these reasons, at the Bank of England, we've been long-term supporters of the FSB's Task Force on Climate-Related Financial Disclosures, TCFD. And we've worked with the UK government and regulators to progress further and implement mandatory disclosure requirements across the UK economy by 2025. But of course, climate change is a global issue. No nation can solve it alone. Possibly only Elon Musk has come up with the idea of diversifying his business away from exposure to the planet. More or less most others are stuck with the planet we have. Therefore, information disclosed by firms across jurisdictions needs to be consistent and comparable to be useful in driving decisions. That points to the need for further international collaboration on consistent approaches to disclosure requirements. For example, the work of the IFRS's proposed International Sustainability Standards Board, which can serve as a useful minimum baseline. And that's important. We shouldn't belittle the word minimum. It sets, in a sense, the foundation. Looking ahead, we need to ensure these initiatives are not only delivered, but then built upon. To illustrate this, I believe there are some really key areas of work we will all need to address over the coming period. For example, the quantitative mapping of the carbon intensity of firms or activities to financial risks and losses remains relatively unexplored. Now, in a way, I think that's understandable. It's a complex area. Data remains scarce. Scenario analysis is still in its infancy. And worldwide government climate policies do not yet fully internalize the cost of emissions. As I noted earlier this week, the biggest component of the journey to net zero is the delivery of clear sector-level climate policy pathways by governments. Let me be clear, central banks cannot and should not try to fill any gaps in that space through their micro and macro prudential actions. We're not here to create and deliver carbon pricing, but we should use our tools to fulfill our role over important areas such as those that I'm covering today. So the final area I want to explore is the importance of central banks practicing what we preach by seeking to achieve best practice for our own operations. Because it's obviously important that we hold ourselves to the same high standards that we expect and want the firms we regulate to meet. As a consequence, we need to ensure that wherever possible, our own financial operations, such as financial asset portfolios we hold, and our own physical operations, such as emissions from our buildings and printing out banknotes, conform to best practices in the measurement, management, and mitigation of climate risks. In line with this, I can confirm today that the Bank of England is committing to reduce emissions from our physical operations so they will be consistent with net zero by 2050 at the latest. I'd emphasize at the latest. I'd be disappointed if it takes that long. In the spirit of transparency, last year we published a TCFD-aligned climate-related financial disclosure. The most challenging aspect of doing that was the inclusion of analysis of the emissions associated with a monetary policy portfolio, a bond portfolio. That was a first for a central bank. We're almost now up to publishing our second report for this year, which will be published in a few weeks from now. And we've sought to build on last year's content to provide additional context and analysis. Now, in March last year, as I was taking up the role, I outlined our intention to assess ways that our holdings of corporate bonds could be adjusted to take the climate impact of issuers into account, while still meeting our monetary policy objectives. Last month, we set out in a discussion paper our proposals for greening our corporate bond purchase scheme. There's no template for a comprehensive framework for greening an asset portfolio held for monetary policy purposes. So therefore, we know that outreach and engagement is critical in getting this right, and we're currently seeking feedback on our proposed framework. So please, we're keen to hear from a range of experts and stakeholders over the coming weeks to inform our next steps. The need for us to act in this space was, to me, clear and unambiguous. There is increasingly persuasive evidence that emissions, and so climate risks, are systematically underpriced in financial markets. This means that continuing to replicate the structure of the sterling corporate bond market in our portfolio without taking explicit account of the climate impact of bond issuers is no longer, in fact, a truly market-neutral approach. Second, the remit of the MPC was updated in March this year to clarify that, subject to achieving our primary objective of price stability, the committee should support the transition to net zero as part of the government's economic strategy, something that we completely agree with. The CBPS will remain a monetary policy tool, with its overall target stock of assets set by the MPC in order to achieve the primary inflation objective. But from the fourth quarter of this year, we intend to modify our approach to the composition of assets we buy in order to take account of climate considerations. Now, the approach to doing that is going to be guided by three principles. First, we want to incentivize companies to take decisive actions which contribute to an orderly transition of the overall UK economy to net zero. Second, the CBPS is actually fairly small in the context of capital markets. It's about £20 billion. We will seek to influence the thinking of other larger investors, as well, of course, as learning from what they're doing as well. And thirdly, our requirements of firms will become more demanding over time, including as improvements in data and metrics allow us more precisely to monitor climate behavior and further to sharpen the incentives we set. The discussion paper sets out how we intend to operationalize these principles and incentivize firms to put in place and abide by credible plans to reduce emissions over time. So let me just sum up. As I've outlined, we've come far, but we've got a long way further to go. And we can't stand still when it comes to climate change. We need to continue to be bold and learn from our work so far to deepen our understanding and inform future actions. Greater ambition and cooperation is still needed, including wider adoption of best practices. And for this reason, as well as evolving our domestic work, we also need to evolve our collective approaches. This year presents central banks, regulators, and policymakers with a unique opportunity to do this. And I have to say, I've been very encouraged by the progress we've made in the G7 and the G20 in the build-up to COP26. Under the UK's presidency, the G7 has started meaningful discussions on the role of finance ministers and central banks in the transition to net zero. Under Italy's presidency, the G20, through the Sustainable Finance Working Group and the FSB, is developing climate-focused roadmaps to coordinate and galvanize international work. And these fora allow us to share experiences and develop common best practice. Listening and learning how others are thinking about the potential macroeconomic, macroprudential, and micropotential implications will be important for that. Now, of course, in addition to that, COP26 has an ambitious agenda that spans all of the areas I've spoken about today. in particular establishing a better understanding of best practice and fostering greater technical cooperation. The Glasgow Financial Alliance for Net Zero initiative will do this by bringing together over 160 firms responsible for assets in excess of $70 trillion for the first time. And such technical collaboration and cooperation is no less important among central banks and supervisors. And of course, the NGFS is key to that. The bank we've widely shared what we've learned, and we will continue to do so. The creation of the Central Banks and Supervisors Climate Training Alliance will allow further support for technical cooperation and assistance on climate risks. So the good news, and we need good news in the current environment, is that in spite of COVID, we've continued to make progress in responding to climate change. But we know there's a lot more to be done. The next stage of the journey will require us to deepen our analysis, evolve our approaches, and further our collaboration. And the coming year is going to be critical for all of us on this journey in allowing us better to convert climate change risks into something that we can tackle for real. Thank you.
Thank you very much, Andrew, and thank you for that journey, taking us through all of the work that the bank is doing, both domestically and internationally, to affect change. And as you say, it is good news indeed. And we note with interest your climate scenario exercise next week, and wish you and your team the best for that endeavour. Before you leave us, we have, I suppose, one question that we'd like to ask you, which is just to tell us yourself, if you to suggest just one thing to coordinate the fight against climate change, what would that be?
Well, I think the most immediate thing is the whole question of getting disclosure standards agreed, getting a commitment to disclosure, because so much, in a sense, that's the foundations of so much that we want to do. Getting an accurate and a sort of consistent understanding of what we're dealing with will, of course, allow us to then, set targets, measure, and assess what is actually done. And it's also, of course, the sort of another key building block in there is carbon pricing. Now, again, it's not for central banks to lead that. It has to be in the political domain, and it has to be worked through. But I do have to say that without that, of course, without pricing the externality, economists would say this sort of thing, of course, but without pricing the externality and then building that piece up onto the foundation of disclosure, it's going to be much more difficult. So those are just very key building blocks for this year. I think it's right that we're doing a huge amount of work on the scenarios, which is important. They will be much more effective then, of course, if we can, in a sense, apply them into a well-founded landscape.
Great, thank you very much. Thank you very much, Governor Bailey. We appreciate your time and listened with interest to your remarks today. So this brings us to the end of today, and it has been an incredibly rich day of conversations on various central bank topics, from green research and development to climate metrics and to disclosure and scenario planning, and I hope that you've all enjoyed it. I have no doubt that this will be food for thought and have a lasting impact. So on behalf of all the organisers, I want to warmly thank all the keynote speakers, moderators and panellists for their contributions today. The discussions aren't quite over yet. We will relaunch the conversation tomorrow morning, early at 8:15, with the man who played a critical role in starting the global movement to net zero, the president of the COP21, Laurent Fabius. So I wish you all a very good evening from Basel, and we'll see you again tomorrow. Thank you and take care.